Well, the question you should be asking yourself today, if you're really focused on the oil and gas industry in the United States, is what happens if crude oil prices literally drop below $60 a barrel and they stay there for any length of period of time? Now, look, we got the Straits of Hormuz. We've got different countries all over the world trying to figure out how to move oil. Everybody's looking at their cost basis. Everybody's looking at their logistics. Everybody's looking at their end customers. The customers are looking at sourcing. The customers are looking at price. They're looking at reliability. All that aside, the largest oil producer in the world makes 13.7 million barrels a day, and that's right here in the United States of America. We also happen to be the largest consumer. So one might ask, well, if the global supply side ends up being a glut, whether it be short term or long term or midterm, the question is if there's a glut and there's an oversupply, even on a short term basis, how low could oil prices go? And what happens to oil and gas producers and exploration companies if the price falls systematically from today's $70 barrel to 65, 60, 55, even down to $40 a barrel? What happens? Which oil and gas producer chokes first? And how do you assess those particular choke points as the price of oil decreases, if it in fact does that? Well, let's just take it from simplistic, right? So you have a lot of what we call independent producers that are backed by private equity. They raise $1 billion, they give 4 or 5 teams 100, $200 million a piece, and they say, find your area of focus, find your business plan, find how you're going to allocate the funds and go spend your money. Well, part of that is the fact that that private equity money comes at a very expensive cost. Private equity money is very expensive and has a very finite time frame. They want you to go put the money to work. They want you to develop the asset. They want you to look for liquidation within 7 years. So there's a clock stop that is being timed every day of the week on private equity. A short-term or mid-term range of decreased prices in commodities can literally choke out or wipe out a private equity-backed group because they don't have the time to weather the storm. They don't have time to come out of the cycle. They have to figure out how to navigate those cycles and do it with limited capital. Maybe they got 100 or $200 million worth of capital, but they don't have another 100 or 200 million to go buy distressed assets because they've already bought assets at the previous price before the collapse, okay, before the decrease in the price of crude oil. So private equity is very sensitive. It's probably one of the first players that becomes weak whenever oil prices go down because they're not going to be given more money. They have limited assets. Their revenue goes down. Their asset value goes down. And the big Papa Bear in New York says it's time to sell you and get rid of you because you're losing money and we're not going to give you more. Then you get to what we call the mid-size, smaller public companies. And these smaller public companies typically have lower inventory of wells to drill. They have limited capital they can spend on drilling new wells. You drill new wells to offset decline curves. You drill new wells to prove reserves, so your stock value goes up. But if you're already a small cap company and you're less than $1 billion, you're probably thinking, I don't have the depth to go get more debt. I can't refinance my debt because I'm borrowing against my reserves. And then when I look at my reserves, as the price of oil goes down, my reserves become less valuable. My cash flow becomes less valuable, and I'm in a decline. If I'm in a decline, people are not going to buy my stock. My stock price is going to fall. I'm using my stock as leverage. I'm using stock as collateral. And so it's kind of this whole wiping yourself with a barrel hoop. There's just no end to it. You just keep wiping your hands in a circle and there's no end to that hoop. Well, as a mid-sized company, when prices fall and stay below, let's say 60, 55 or $50 a barrel, they're going to be in deep trouble. They got a lot of high cost debt, whether they have $100 million in debt. Typically, the smaller the company, the higher the cost of the debt because they're not very broad. They don't have a lot of assets. They don't have a lot of way of collateralizing the debt. So they're going to get really high market debt, 8, 9, 10, 11% debt. That's expensive. You add that debt on top of lower revenues, on top of lower value for the reserves, those mid-sized companies are in trouble. Then you get to the big boys. You say, okay, what about the big public major companies, right? Price oil goes down. Well, historically, what they do is they simply modify their activity by what they believe the forecast going forward is going to be for commodity prices. If they're in a downward trend, like in COVID, where they saw it was going to be a 6 months to a year decrease in demand, man, they laid off rigs as fast as turning off the light switch. I mean, we went from 700 drilling rigs down to 214 drilling rigs active within 90 days, the lowest number of active rigs we had since like 1928. But they said the only way for us to prepare for this downturn in oil prices is we got to shut off the spending spigot. Lay down rigs, stop drilling, delay fracking, don't drill, don't add more leases. Just hunker down, produce the wells that we have, generate enough cash flow to sustain us to get through this weathered storm. And when things get better, we'll come back out and drill again and we'll produce again and we'll add reserves again. But right now, don't spend a dime. Don't buy new coffee cups. So the majors understand they have the depth for surviving. They have the depth of longevity. They have the depth of being able to say no to further capital deployment when capital deploying is not a smart move. But they too get crippled when the price oil is below $60 a barrel because they become unmotivated. See, what most individuals in this country don't understand is there is a certain dollar threshold that makes certain geological exploration activity uneconomical. You can have billions of barrels of oil in the ground. It's uneconomical to drill it. See, you wouldn't go to work if you earned $500 a day in income and it cost you $550 to go to work. You wouldn't do it. Well, the oil and gas industry in the United States doesn't either. See, it's owned by free enterprise. It's a free market. Our oil and gas industry, unlike most countries, is not owned by the government. It's owned by individuals, and individuals make great decisions. The smart ones do about what do I have to do in surviving, thriving, growing, and protecting my downside. I move and I change my direction. I change my position based on commodity prices because it's going to directly affect my cash flow, directly affect my capital I can spend, and directly decrease or change the value of my company and my assets. They're going to respond accordingly. The other things you don't think about as a outside the oil and gas industry kind of participant looking into the oil and gas industry, you don't understand there's a lot of costs we incur that other countries do not. What are those costs? Well, when you produce oil and gas in another country, well, guess what? They don't have to pay for the midstream. They don't have to pay for the gathering, the transmission, et cetera. What they do is they pay for really the price of oil. So these public companies, these private equities, these larger exploration companies in the United States, they don't have just the cost to drill the well. They have a cost to drill the well and the other cost to get it to market. And they have to pay the troll underneath the bridge a fee, a tariff, a transportation cost, a gathering cost, a per barrel transport cost. And so each one of those particular oil and gas exploration companies has to figure out how much have they secured in a firm contract or a reliable contract that says, if oil prices go down, do I still owe you $2 a barrel, or does your contract pay a lower tariff because it's maybe commodity sensitive? Or do I even have the ability to get into your line for less than a certain volume? And if it's a certain volume, is it the right product? Is it the right kind of sulfur mix in that crude oil barrel? Is it the right MCF and BTU for that gas that I'm producing? So there's a multitude of factors that go into which companies, which oil and gas enterprises, public, private, or private equity backed, suffer the most if oil prices drop below $60 a barrel. Well, having 4 decades of expertise, what I can tell you is one thing's for sure. You'll find out very quickly the best places to drill in the United States, because as oil and gas prices drop, the rig count drops, the location of those rigs clearly identify. Only these remaining locations are economically viable at $45 a barrel. Only these companies that are currently drilling at $45 a barrel have enough depth to their financial statement and their balance sheet to say we can afford to drill, and we can put pressure on our vendors and drilling contractors and suppliers to say you've got to lower your cost by 30 or 40% so we can keep drilling at a commodity value that's 30 or 40% lower. But you're going to learn real quickly, follow the rigs. The rigs tell you the best place to drill at the lowest commodity price. The oil companies that are active at the lowest oil price with the active rigs are the most successful companies because they have the deepest pockets, they have the greatest bandwidth, they have the most reserves, because that's why they survive and drill like crazy when the oil price is down. As most of you probably know, being a contrarian is very tough. Being a contrarian in oil and gas is even tougher because you're going to have to spend money and invest money and drill and discover new oil and gas at the worst possible time as your revenue's drying up, as your reserves are going down in value, as the banks and shareholders are putting pressure on you to keep those dividends going and those interest payments being paid. But your business sense says you drill when it's cheap, you explore more wells when it's cheap, you drill faster, you complete faster, you spend all the money you can and all you can afford when the prices are cheap, because then you get the upside of commodity price on the back end. Look, I can tell you, sub $60 a barrel is destructive to the oil and gas industry. The president of the United States says, drill, baby, drill, but I want you to do it below $55 a barrel. It will not happen. We cannot compete with global producers because they have a much lower cost base than we do, because the government owns the oil and gas industry. As a private industry, we have rising costs: labor, diesel fuel, chemicals, supplies, cement, pipe, steel. Everything is costing us more in the United States. And as a private sector, we have to pay those costs, which means it's costing us more per barrel to produce. And at some point we say we are drowning. We can't drill the next well because its break even is higher than our profitability. Guess what, folks? In the United States, $60 oil will separate the men from the boys very quickly. I hope we don't see that, but it's a possibility. Take care.